Oh, that's bad. That's bad. I looked over nearly a minute late. Okay, guys, let's restart. Ladies and gentlemen, big in the news today is SoFi getting shorted out the wazoo. Okay. Then we're going to be talking about Shopify obviously being in the news. Between Black Friday to Cyber Monday, they released their full numbers, as well as PayPal actually releasing those numbers as well. We got Bank of America, Goldman Sachs, and Bill Ackman in the news as well. We're going to be covering it all. But first, Justin brings up a good point. Rest in peace to a legend. Charlie Munger, the right-hand man to Warren Buffett, and someone that both Warren Buffett and Bill Gates had said was the smartest person that they had ever met. Charlie Munger passed away at 99 years old. That's sad. Okay. Lived a good life, I got to tell you. Okay. So let's just jump right into the news. Let's start off with a little Shopify to start because, it's really good news. keep the news a little bit positive. Now I'm going to see in the chat a whole bunch of people just saying muted as people are just starting to flow in. I'm extremely pink in this white light. Maybe I should have white balanced before. Here, let me do that. I'm going to do a quick live white balancing for you guys, show you how the process gets done. Put this little sheet here. Click it over and boom, look a little bit nicer, sort of. All right. Okay. Shopify merchants reached a record $9.3 billion in sales between Black Friday to Cyber Monday. What's very exciting is that whenever we were talking about Black Friday numbers, what we actually saw whenever it was released, my makeup is way off. That's so funny. Okay. What we actually saw whenever the first day was released, Black Friday, is that the growth from last year was actually 22% higher year over year, versus last year was only 19%. Okay, so we actually saw better than expected accelerating growth rates. Very exciting. But for the actual whole weekend, what we saw was year over year growth rates of 24%, an acceleration of the total weekend versus just Black Friday. People spreading out some of their purchases, which was very, very exciting. Big countries selling US, UK, Australia, Canada, Germany. I'll just share my screen, by the way. I'll let you guys see what I'm seeing. This is directly from the Shopify website. This is what they shared. Top cities, cross-border payments represented 15% of all global sales, which was the same as the single day. 60% year-over-year increase in sales made via Shop Pay. Unbelievable, which is obviously going to lead to a higher percent of monetization per purchase, not just in total growth in sales, right? Highest categories: apparel and accessories, health and beauty, home and garden. People are spending. Doesn't seem to be a weakness in consumer. Maybe whenever you look at things like buy now, pay later, those are growing extremely strongly as well. So maybe people are trying to defer some of those payments, but still very, very exciting. 61 million people had purchased, unique people had purchased on Shopify. Very, very exciting. To add to this, Harley Finkelstein, who is the president, shared this tweet right here. Total Black Friday, Cyber Monday sales by Shopify merchant the last 5 years: 2.9 billion, 5.1, 6.3, 7.5, and most recently, $9.3 billion. You look like a beautiful newborn baby in that light. Yeah, you know what? Kelly's actually a part of this large increase in sales. She runs a couple commerce stores, so I appreciate you, Kelly, for running them on Shopify. No one could have been able to handle that level of scale. And in fact, one of the things that Toby Lucky, the actual CEO, actually posted was that although they saw a 22% increase in sales on Black Friday, they saw a 38% increase in people on their actual website, like traffic to their websites. So not only are people purchasing way more on Shopify, but they're actually going on Shopify to shop and search and just look around, which is definitely the first step of making your purchase. So hopefully continuously year after year, people will be more willing to use e-commerce. But yeah, very, very exciting. They processed 145 billion requests on Friday alone. Okay. Let's jump in. We got, we're 5 minutes in, 160 plus people here. Let's just talk about SoFi. All right, let's jump right in. Let me just close some of these tabs so I don't get lost. I'm going to be using Koifin. They are an affiliate of the channel. If you guys like this software, you can check out my link down below. I use them literally every single day. Now, what you're seeing here is SoFi's historical price, okay, which is this bottom, hollow candle chart right here. And then these two lines right here, which I'll show you the short percent interest, which hit a very high amount just recently of 13.66%. It's a little bit small on your screens. Let me try to do this to make it just a little bit bigger. Historically speaking, I think we did reach a little bit higher than that previously at 14.14%. But due to dilution in the actual stock as we issue more shares into the company for stock-based compensation and other things like this, that as a percentage, it's important to look at. But not only that, as simply the short interest dollar amount, okay? $131 million is now the new recorded amount. This actually was not the peak. I think it was Chris Hager say this was the highest amount of shorting that we had ever seen. That's not from the chart that I can see here. Back from June 30th, we actually hit 132 million. As the stock had hit, close to the $8, $9 ranges, that was really much higher. And in fact, it actually lowered whenever the stock was at the $11 ranges, which is funny. But regardless, short interest is starting to climb back up. People are definitely very less confident in SoFi than historically they have seen, right? This is all I want to say. And I won't keep this too long. We continue to add new members onto the platform. They continue to cross-pollinate into other products that is leading to, bigger lifetime value per customer as we continue to reach out and get new customers over time. That is happening all right now. We just got contribution profitable on all three segments of our business. Lending, technology services, the technology platform, which has been there for a very long time, but just most recently, which has been holding us down, was financial services. Not only was that not, contribution profitable, but because it was actually in the negatives, it was actually dragging down the other two categories as well. Now, all three of them are profitable, which means not only are we going out and getting a person for credit cards, invest in SoFi Money or SoFi Relay just to acquire them to get them over to lending, but they themselves in those categories are profitable on their own. Now, maybe that cannot be said for credit cards and invest right now, right? It's mainly because of SoFi Money. SoFi is so monetizable, the checking and savings account product, that it actually makes up for all the losses in credit cards and the invest product, but those slowly become more monetizable over time as well. We've already seen that. They said they were, those two categories alone, credit cards and invest, were kind of bringing down SoFi by $150 million. They said that 2 quarters ago. This most recent quarter, they said it's bringing us down by about $100 million. Okay, well, that's a very sizable increase, practically a 33% increase just looking at that metric alone for those two categories. SoFi Money, however, because we just hit $3 million in contribution profit, that has brought us above that $100 million gap. It's very, very profitable for us. There's only more members on SoFi Money right now. What I'm going to hopefully continue to see, and maybe I can bring this up on a chart, I wasn't expecting this, so bear with me here. But not only are deposits growing because we're bringing on new members onto the platform, deposits per member for SoFi Money members is also growing just in that aspect alone, which is very, very exciting. It means that the amount that we're able to monetize on a per user basis is also climbing. So what did SoFi actually say about this? They said, for the foreseeable future, contribution profit would continue to climb up, okay? That's very, very exciting because they see it never going back into the negatives, or at least as far as they can project out, okay? I think that the reason why people are shorting could be a potential that they just, are, potentially thinking that the guide for 2024 might be worse than they expect. Or I cannot see institutional investors or people that are shorting this stock believing that SoFi won't be gap profitable. I know Vitaly said that on the Fintech or on the Finance Junkies. I don't believe that. They've been guiding for Q4 profitability in 2023 since like Q2 of 2021. Ever since we actually SPAC'd onto the market, they've been talking about 2023 being a profitable year. Okay. Fast forward to the most recent or Q4 of 2022, whenever they were giving the full year guide, they said we'll be profitable by the last quarter. Now in Q3, they're saying next quarter, the quarter that we're already bleeding into, because the actual quarterly report, whenever they make their call, is already a first month into the thing. They're saying we will be profitable this quarter that we're in right now, the quarter that we only have a month left to see. That I think that's probably baked into institutions' predictions. I don't see that a way that that's not the case. What I think is very important is what will 2024 guidance have to say for the entire year? Because what will be important is if they have that same line that they said about contribution profits, is that net income will be positive for the foreseeable future. I think definitely changes the way people can look at SoFi. If that's the case, at least in my opinion, I've always been a bull of this company ever since I first started deep diving into it. So maybe I'm the wrong person to maybe make that call. But the way that I see it is that would change people's perspectives of how speculative that this stock can actually be. But let me tangent off. I'm going to take a sip of water and then I'll continue on. Vitaly was drunk on potato juice when he said that. Maybe I didn't ask him about his vodka intake. Who knows? But yeah. All I wanted to say though is that what was I going to say? I was going to pivot there for a second. Anyway, maybe I'll find it again. I think that guidance will be extremely important. Like I said, shorts, although being painful for people that don't understand the business, doesn't actually impact the company if we don't have to dilute shares, right? That doesn't seem to be the case. And I think that people are really trying to compare this company, at least institutions, to Lending Club. And I think the one thing that they're looking at whenever looking at SoFi is they're looking at it just a numbers basis. And they see, SoFi, and then they compare it to Lending Club and they're going, how is this company still staying afloat? There's no way that they can continue in this marketplace. And there's also I think whenever this is the problem, and one of the things that I will counter, and this won't be the first time I bring up Chris Hager's name, but he talks about data-driven investing. And the one thing that I would counter that is that the problem with data, it's really hard to spot how strong a brand might be, right? Numbers can bring out a lot, but a storyline might also tell another story as well. It's why I think Cash App does so well. On a statistical basis, it might not do well for people because it seems like an expensive stock, but then the stock also ran, like 70% over the last month. So obviously there's something in there that, people would also like. One thing that I think definitely differentiates SoFi from companies like Lending Club is that people are more willing over time to join SoFi based on a referral or based on how strong the brand is, rather than Lending Club at all. I've never even heard of anyone opening a Lending Club checking account. And I don't think that I will continue to hear of anyone. Maybe some people over time, if they're given great sign-up bonuses and you have to pay for the consumer to come onto the platform, but that's not how you grow a strong brand, right? I think that's where people sort of differentiate between institutional and retail. Is a lot of it is, what are people saying on the street? It's very hard to sort of put a monetizable value on that or some intrinsic value into how strong a brand is. It's very hard to do that. I think that's how retail sort of found Tesla before institutions found Tesla, because before the numbers started to pour in and before profits were actually made, people realized that Tesla had a better brand and a better product than their competitors. Okay. I think that there's a lot of those same sort of signals in SoFi whenever retail looks at SoFi that institutions just simply aren't seeing yet. And I'm very positive on SoFi beating these shorts, and I don't worry that these shorts are here because necessarily it's not going to affect the stock if we don't need to dilute. The only way that shorts are an impact and a stock price actually getting brought down is if we're trying to acquire a new company like Technisys, or we're trying to just issue new common shares to the public market to raise some capital. We don't need to do either right now. Potentially we might look for acquisitions at super cheap rates like we did for Wyndham. And in that case, we didn't even dilute. It was all cash, and it might have been less than $100 million. So frick, it's like, a pretty good freaking buy, especially for if you want to be a one-stop shop. Okay. I might jump back over to SoFi as questions come in and we can talk about that. But I did want to bring up something that happened today that feels like zero news to me, and everyone keeps bringing it up as if this is some big deal. Goldman Sachs has decided to end its partnership with Apple on Apple's credit card. Okay. This news just popped back up. People are freaking out again. I'm getting added by Chris Hager on Twitter saying, look at, Tanner said this credit card was going to be a competitive advantage for Apple and other fintechs versus what SoFi is offering because they have the hardware. At least that's, that is what I said. That's not necessarily what he said, but. And now this, of course, Goldman Sachs leaving is somehow showing that Apple isn't doing well with their credit card. Well, that's not true at all. Okay. First of all, this report was made back in June. I don't even know what people are talking about. We already knew about this. We made, videos about this a long time ago. Here, I'll even show you. This was a Reuters report from back in June. Oh, they just gave me a big Energy Talks ad. But anyway, you can see it here. Goldman Sachs may exit partnership with Apple, Wall Street Journal reports. And then, in fact, they also talked about how the bank is in talks with American Express to take over its Apple credit card with other venues with the tech giant, the report added, citing people familiar with the matter. Okay, so if the first part of the rumor is true, then maybe the second part of the rumor is also true. Or maybe it's a different company altogether. But who is suffering in this partnership? Is it Apple or is it Goldman Sachs? Because Goldman Sachs is not happy with this partnership. They said they lost potentially $1 billion just over the last year on this partnership. Apple's thriving. They're signing up people at a very high rate. They are having no problems with this. Some of the problems that they're bringing up is that, or from what I read from, I forget who the source was, but they were talking about how the Apple is trying to push Goldman Sachs to accept more people even whenever they don't fall under the right credit boxes. And that's potentially hurt their credit losses because people, they had no faith that there was going to be any repayment to begin with. And Apple pushed them to that. They also pushed them to sign them all up around the same time, start of the month, which also pushed them to have a ton of inquiries at one time of the month rather than splitting it out across the whole thing, which has been pretty cumbersome on their employment and customer service. Okay, so it takes two parties to make a deal here, okay? Goldman Sachs had to agree to the terms that Apple had placed out before actually getting the credit card. So, okay, Goldman Sachs got way over their head with the quantity of credit cards rather than having to worry about the quality or the monetization on their side of the agreement. That doesn't hurt Apple at all. If Apple wants to show up and boast their big brand and try to get a big company like Goldman Sachs or Amex to take a lower cut because they're so big, that's up to Amex or Goldman Sachs. If no venue is willing to actually take on Apple credit card, what happens? Does Apple credit card go away? Or do maybe they lower their monetization a bit till they find a suitable partner where both parties are willing to actually take on the deal? I mean, if anyone is saying the former, you're out of your mind. It's the latter, of course, right? They're already offering the product. They're not going to back away. One thing that I think is important, however, looking back on it, for Apple to offer a credit card, like a true credit card, rather than a prepaid card or something like this that might still offer high interchange fees, it does seem weird to me that Apple would offer that and also try to control the credit boxes that the consumer is trying to get. Because obviously, Apple is for everyone. So to have a credit product, you kind of have to say no to a lot of people. Doesn't quite fit in the brand, in my opinion. Whatever. That being said, this is an absolute nothing burger on the idea that Apple is somehow not able to offer these products. There will be a person or another partnership that they will find, okay? At least that's how I see it. If for what I'm also not worried about is how much Goldman Sachs or Apple is even monetizing this product. The only part that's important to me whenever it comes to Apple credit card or Apple savings account is that if you do have a Apple credit card or you do have an Apple savings account, that makes it so then you might not need another credit card or another savings account. So it takes away from the total pool rather than how monetizable it is. People keep bringing up in the argument whenever I say Apple is a threat in the fintech world that they go, oh, well, they won't be able to monetize it nearly as much as SoFi. That doesn't matter. Who cares? It still takes a client away from other competitors, right? That's the only thing that matters. So it's a threat, not necessarily saying I'm buying any Apple stock. I'm not. But I don't think that because Apple joins fintech, that doesn't hurt other competitors. Anyway, I'm off the topic. I did want to watch a little YouTube video with you people. Just quick, 50 seconds. Let me turn off the music. This is important. Bill Ackman is definitely a person that I listen to, but I listen to from a perspective of him wanting to secure his own interests, right? There has been countless times where Bill Ackman has said that he likes or dislikes something, and then trades the complete opposite way once the actual market has moved in his favor to price his trade better. Okay? Setting that up, I'll now show you the clip that I'm wanting to show you. This is him talking about interest rates and where he thinks they're going to go going forward.
Stimulus. So you have a view on what the Fed's likely to do?
I think they're going to cut rates, and I think they're going to cut rates sooner than people expect, because what's happening is the real rate of interest, ultimately, which is what impacts the economy, keeps increasing as inflation declines, right? So if the Fed keeps rates in the sort of middle fives, and inflation is trending below 3%, or that's a very high real rate of interest, and I think that is having a sort of retarding effect on the economy. And then, of course, again, many businesses and certainly many individuals have the benefit of fixed rate debt. And that fixed rate debt, certainly for companies and for commercial real estate, starts to roll off. So I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
By its own admission, the
I did just want to show that off really quickly, as early as potentially Q1. If that's the case, Stephen Fiorillo has been showing that off a little bit, how there's been an increasing probability that this could be potentially, get cut in March. I think the last time we said it was a 28% probability of a 25 basis point cut. Could be quite interesting, especially in the favor of fintech. Essentially, all fintech companies benefit from this. In fact, a lot of just the general, stock market could benefit from this as interest rates lower, continue to lower over time. That means cheaper access to capital. Cheaper access to capital means potential better rates on leverage, and which means you could essentially grow faster. It's why during a zero interest rate environment that, stocks just exploded through the roof, because you could just continue to double up, triple up, 5x your amount of capital, go out and acquire new engineers and try to get as much of a new market as your product is willing to capture. It definitely benefits SoFi as well. It prices a lot of their new loans that they had just given out at much higher rates. As interest rates stay high, our average coupon rate is climbing, meaning how much we receive per repayment, or well, actually the percentage is on an annual basis, but divide it by 4, whatever, per quarter. And then as rates start to drop, especially if it drops very quickly, that can reprice higher debts very quickly. So, people talk about what the fair value of our loans are. Wait till rates actually start to come down. It'll show you quite a different picture on the fair value of SoFi's loans. Very, very exciting. The earlier, the better in SoFi's case, that's for sure. It would definitely kill a lot of the shorts, I guarantee it. Speaking of, I cannot believe I passed up talking about Shopify's merchant growth without talking about what Alex Chriss had to say. Alex Chriss being the CEO of PayPal. Now, the only problem I have with this, some people were saying how amazing this is. I'm going to be a little bit I mean, it's great, but here, I'll just show you. I'll just be very objective, though. Our preliminary PayPal numbers from Thanksgiving to Cyber Monday shows the impact we have with our customers. Processing approximately 400 million transactions, put $8 million back in customer hands with cash back and savings. And then Cyber Monday was the largest shopping day of the year with approximately 5.8 billion in TPV and 87 million transactions. Welcome the new dog, by the way, if anyone can see her. Raina, come here. Jump up. Anyway, come on. Come say hi. Yeah. Yeah. Hey, girl. Anyway, that's our new shelter dog that we just adopted. So what is very interesting about the PayPal numbers is that they didn't show off what the growth was year over year. It kind of, I think he had an opportunity to be very transparent and didn't actually show off where it actually was from. So 400 million transactions seems like a ton. We have 430 million users. I don't know if this is a lot or not. Is it a lot between, Thanksgiving to Cyber Monday for less than every user to make one transaction? I don't know. And anyone that says that they do know, I mean, you better be an insider because I'm not going to just take your, your faith numbers for it. But yeah, anyway, let's see what else. This was quite interesting news as well. Bank of America. So I just read this. Bank of America was fined $12 million for reporting fake mortgage data to the government for at least the last 4 years. I don't know if 12 million is a lot for that case. Obviously, for the grand total of the total amount of mortgages that they deal in and all of these things, $12 million is, you can't even call that a fine at all. That's a nothing burger, but maybe the impact of what they were actually doing was also small as well. We have no idea, but still, you're not seeing this out of some of these younger companies and, companies like SoFi. I potentially wonder, is it baked into the idea that because these banks are dealing in such high numbers that some of this is just error, or is it actually, malice? Are they doing this intentionally? I think because it's only 12 million, maybe it wasn't intentional. I'm not sure. Reporting fake mortgage data, maybe that is. I don't want to read into it too much. I guess what I'm trying to say is, when will some of these newer companies like SoFi and these sorts of things begin to actually see fines like this? I mean, SoFi has been fined previously. I think from the SEC, they did a $250,000 fine for something a while back, is what my memory is serving me. But anyway, yeah. Crossroads says it's 15% of the amount of all Q4 2022 transactions in 5 days. So not bad for sure. Yeah, but was it 15% last year as well? Because it would make sense that, those are the biggest sales days of the entire quarter. So is that normal? That's all I want to know. Saying these statistics, 400 million sounds extremely high. 87 million transactions in a single day sounds ridiculous. But it's not like Q4 hasn't always been an amazing spending time for PayPal. It's always been their strongest quarter. Impossible to know. Yeah. Hopefully, as Alex Chris continues to stay in the business year over year, that we'll be able to see those numbers and compare them. But who knows? Maybe potentially they can put out an entire slide. Obviously, they have that data. So if they really want to show off, Alex Chris would have those numbers. He should post them. Okay. Anything else that we want to cover, especially from SoFi's perspective, or are we just going to go? I think it's important to remember that if you know a business and someone else is the reason why shorting can seem scary is that you potentially don't know as much as the person that's shorting. I do a lot of research into this company, the community in general. It's not me that does all the research. And in fact, I probably do a very, very small minority of it. I think the majority, though, does come from the entire retail community for SoFi. But together, I think that we do put together pretty good research on the company, and I feel like I do know it to the point where someone else shorting the company or selling the company down to a certain price has never took away from my conviction. And in fact, the things that I do place on or scrutiny onto the company has been my own thoughts, right? And I think that is just the same thing that we just have to continuously do for the business as we continue to do research and get better at our research, that we question everything. And it definitely doesn't make me a bear for doing such. You guys are crazy. It's true. It's true. Did Tanner just start? Sam, you're a member here, my friend. I do this every day at the same time, 8:30, never later. Okay, it's always at 8:30. I don't know of a day that I have been late. But yeah. Speaking of Galileo membership, getting to the top 50 banks, so much going on for SoFi. Yeah. Okay. I'll stay here for 5 more minutes to talk very quickly about SoFi. SoFi does do Samsung Money's savings account and potentially a payment card whenever that can happen. All of that is very exciting, and it could lead to potentially Apple going to Galileo. We have the infrastructure, we have the payment processing. We do also have the actual bank. Like, for example, can Amex set up a proper savings account? I'm not sure. I know SoFi can. We actually have the sponsoring bank. I actually think Amex can, which I don't know why I said that. But anyway, regardless, that I do think that SoFi does have the ability where there's no other company that has the infrastructure tech and the payment processing in one, let alone a sponsoring bank that also would allow for, a FDIC member and an ability to actually host those deposits. It's a pretty killer trio that not a lot of people talk about very often, but we always have to remind ourselves how unique we are in the market and the offering that SoFi and the tech platform actually offers. I really have to think about how many accounts SoFi actually offers through Galileo. Some people forget that. There's like 500 million checking and savings accounts products out there in the United States, or at least that's what it was a couple of years ago. Maybe it's, let's say growth has been great and it's 600 million. Galileo services 130 million of those. Think about it. We're pretty sizable. So potentially we could land in Apple, for example, especially if Goldman Sachs is backed up. But only if it's in our favor to do so. We'd have to lay down the law. But I also think that Anthony Noto is someone that would not bend their terms to make a good deal happen. And I'll give you a great example. It would be Cash App. I am sure of it, okay, that during the time where Marqeta and Cash App were sort of in a debate stage and contracts were not being renewed, that during those, RFP times, that Galileo was sat down with Jack Dorsey, especially the relationship between Jack Dorsey and Anthony Noto. If people don't know it, you got to research it. Okay, they're very close. That we have offered our product to Cash App and they didn't take it. Why is that? Okay, I'll tell you. Or at least I'll tell you from an uneducated but guessing point of view, okay? That Marqeta, for example, has about a 70% gross margin on all their products, okay? Whenever it comes to Cash App, however, they were given a different term than the other companies. So on average, they get 70% gross margins. But as you scale a larger and larger business, you're willing to take a lower fee because it's quantity over quality. For Cash App on the Marqeta platform, they re-upped on their contract at only 35% gross margins, which means they're taking half what they're taking for all the other companies that they're servicing on average. Okay, now let's compare that to Galileo. Maybe Jack Dorsey had came to SoFi and said, hey, you can do this, but we want a much better rate. We want half the rate than what you're giving out to your other competitors. And Anthony Noto said, Nope. We want a fair deal for us too. And we're not willing to service you just because you're a large client. I think that's important. That's at least the way that I read into that. And potentially with a client like Apple, maybe Galileo couldn't win a client like that because we're not willing to budge and lose $1 billion over a year just to service the largest client. And Apple might be pushed to an extreme where if Amex doesn't take it, if Goldman doesn't take it, and all these things, that they have to sort of lighten up on their take and give some more of the monetization to other venues. Then maybe Galileo can swoop in. Just my opinions on that. William says, "Rip Charlie." Yeah, rip Charlie Munger. All right, guys. Thank you all so much. Really do appreciate your time. But I'll see you tomorrow for the next FinTech Frenzy live stream. Bye for now.